David, welcome to the Paper Cut Podcast. It's fantastic to have you here today. David Peterson, the Chief Innovation Officer with FNBB, First National Bankers Bank. And for you listeners that don't know, First National Bankers Bank is a bank for banks. And, Surety Bank is a shareholder member of First National Bankers Bank and have had a wonderful relationship over the past, many years.
Ryan, I'm excited to be here. Appreciate you inviting me.
Yeah. First thing, David, a chief innovation officer is kind of a new development that is coming across in the banking world. What is a chief innovation officer?
Yeah, when I tell people that I'm a chief innovation officer and for a banker's bank, we serve other banks. I also tell them that I have a rich fantasy life, right? So this idea that as organizations, whether you're a bank or whether you're a retailer or whether you're a wholesaler, regardless of what you are, innovation has to be a part of something that everyone from top to bottom has got to sort of take on. It's got to be something that's enterprise-wide. But banks are a little bit behind, generally speaking, the innovation curve, right?
Why do you think they're behind?
Well, because there's a number of things. Number one is tradition, right? So we are very tradition-bound. Number two, we are process and procedure bound. We are the second most regulated industry in all of the world. Only nuclear facilities have more rules and regs that we have to
and the healthcare right below us.
That's right. So, right. And so if you start thinking about all of these rules or regs, it sort of lends itself to being more careful, more guarded, right? And so in Baton Rouge, I've got a room that was an old wire room, wasn't being used anything. I said, I'm going to make that my thinking room. It's going to be a place where you can go and brainstorm or whatever. And so I put a big saying on the wall. It said, innovation occurs when failure is an option. Think about that. If we're not willing to fail, if we're not willing to try something and have it not go exactly right, and then figure out, wait a minute, what happened? Let's iterate. Let's fix that part, whatever. That's not the legacy of what most financial institutions have done. Financial institutions are planners. If we're getting ready for the next big wire thing that's going to come out in March 2025, right? We've been planning that now for 2 years to figure out how we're going to get it done. So we're very anti-mistake. Banks don't want tellers who can't make good, keep their drawer balance, right? We are anti-mistake.
Well, there's a few things that have to be constant, and reconciliation and compliance is a absolute must. But when I think of innovation, for innovation to work, it has to be more efficient and it has to reduce errors. So,
Right. So it's a conundrum because the bankers, most bankers, very much like you and your institution here, know that that they have to be on top of innovation. There is a legacy of customers, perhaps in Central Florida here. Maybe a lot of your larger depositors might be baby boomers or even still some super seniors. Mm-hmm. And so we start to think about, well, how could we transform that retail space, when people walk in and everything that they see? And some banks would go, whoa, if we start making radical changes down there, that's gonna upset our traditional customers coming in, and they want that sort of traditional look. And I think, well, I'm not sure I'm really worried about those customers. I know that we have to attract young millennials and Gen Zs because those older customers, long term, are going to go away. And how am I filling the top of the funnel? All of the studies show that young millennials and Gen Zs want to have a physical bank building,
even though they don't go to it,
even though they have no intention of going to it, but there's something about money that's different than any other product or service, right? So if they had an issue, they had a vexing problem, they could go in and actually schedule an appointment and talk to somebody. And that's borne out in terms of, what if we changed even the way that we organized the retail branch to a place where people would want to come? There's a reason why they would go there, not because they have to. In the past, we had to come in the branch, cash a check, make a transfer, right? And you had the queue lines look like Disney, especially on a Friday afternoon, right? All these people cashing checks or whatever. Nowadays, today, even in your building right here at 11 o'clock, there's not going to be a huge line of people waiting to do something downstairs.
No, right? The average, and each location is completely different. So in our location here in DeLand, the people that are going to come into the branch typically is senior citizens with CDs, and businesses that deal in cash, so they're change orders.
Right.
So that's what you're going to see on the average for that.
That's right.
And still, people that, for most part, a lot of people still want to come in the branch to open up an account.
Yeah. Even though you have online account opening, even though you have other ways that
you know
can
what?
do that.
I'm kind of different. I'm not. We don't provide the online account opening.
That's fine.
And here's the reason why. Because 99% of the banks that have done that, it's fraud. As soon as they add like the frictionless, the account opening, majority of them. Yeah. So we open up accounts remotely, but we integrate and make sure that customer service representative is talking to that person. Yes. And to reduce fraud.
So long term, I think that when we think about technology, and let's just use online account opening, for example, because I think you're right. If I don't put eyes on somebody, if I'm not physically looking at their, driver's license or, forms of ID and so on and so forth, the idea that fraudulent accounts could be opened is certainly an important one and one that's likely to happen. But as time goes on, and you start thinking about innovatively, what if somebody wanted to open an account at Surety Bank? What if they wanted to do that remotely, and they're not trying to do it fraudulently?
Of course.
Is there a way we can accommodate that? And so you start thinking about, what if we ask somebody to take a picture, a selfie, with them holding their driver's license right next to their face?
For $15 and only fakes, you can pass that. It'll pass the KYC.
Right. But again, there's other metadata that comes as a part of that picture, right? It's like, I know that they're somewhere here in Central Florida, not in Uzbekistan, and so on and so forth. So all I'm suggesting is that there's nothing wrong with saying we want to open accounts, and put eyes on and make sure they're not fraudulent. But we have to think about, what's the mechanism, what's the way that if somebody wanted to open an account and didn't want to physically come in to do that we could do that in a safe and sound manner. And so that's the target of innovation. So to your earlier point, what's the point of innovation? Why are banks behind, right? Is because they're not focused on outcomes. What's the outcome that I want? I want to open a new account. I want to get as many people to open a new account at my bank as possible. And so if there is a way that I could innovate and do that to the point where you would feel comfortable that I can do this with a minimum amount of potential fraud that happens, but yet still enabling somebody who wants that online account opening experience, that might be the angle of innovation.
Now, you seem pretty focused on that upfront customer service. Do you have any other examples of innovation within an organization or a bank successful? Because, there's very little data out there for, say, neobanks that are having 2-minute frictionless account opening. Whether you've got Chime. I mean, Chime's private, so we have no idea the profitability of that company. That's been presumably the most successful neobank out there with the volume, but realistically, their numbers of customers, I don't know if it's actually legit, because I got a debit card and never gave them $1 just because I signed in, name online to check it. I haven't seen any data of the neobanks that are actually profitable whatsoever.
I don't know that there is any. In fact, here's some interesting information. If in fact internet-only banks was something that there was a big demand for, there would be a lot more of them. So every summer I teach at the graduate banking school at the University of Colorado. Hey, it's hot in Louisiana, so I get to go out to Boulder in July. But one of the things I ask my students, I got 175 first-year students, all have to take my technology class. How many internet-only banks can you name? Go, right? And so they're like, Ally, right? Yep. Or Chime, right? And it's like they can't come up with 5. They can't even come up with 3. And if you go back in time a little bit and you think about Movin' and Simple and all of these online,
they all sold because they were losing their butt.
That's right. And so all they were really trying to do is generate a market share. They came out with a bright, shiny object that said, for this particular niche of customers, we can pull them in, and then they turn around and flip that over. There is no real demand for an internet-only bank. There's no reason for it. But for a regular traditional bank like Surety Bank that has physical offices and has all of the things that you do with FDIC insured funds, and all the things that make your customers safe and secure in terms of how you do it, a very robust digital presence for people who come in, open their account, and maybe never step a toe in your branch ever again. They don't need to. They can deposit with their phones. They can, they can transact and go wherever they go. They might even move out of the Central Florida area and go to Georgia or North Carolina and still wind up banking with Surety Bank because of that strong digital presence.
We're nearly 100 years old, but our largest growth is outside of our physical locations.
Yeah. And so this is what I try to help banks understand. And you're a young guy. You're a very progressive CEO. A lot of the financial institutions have, let's say, an older CEO that came up in the time frame when we didn't have the kind of technology that we had today.
Well, I mean, most of them right now I see are just sitting on the side, and they look at risk and you're saying, okay, there's only downfall. I've got so many years of retirement. I'm above the Mendoza line. I'm just going to continue on. Why would I risk something bad happening when I can just sit for the rest of the time?
It's fair. It's a fair point. You've got banks that are strong with a strong succession planning, somebody that's coming along that's going to take the bank on, and they want to see that continue. And then another bank, maybe there isn't a strong succession plan. He's saying, well, I'm going to get to a certain point and sell out. So why would I invest in a big technology platform? I'll keep my powder dry. I have as good a financial profile as possible, right, to sell out. So those are issues. But just yesterday, I spoke at a conference here in Orlando, and one of the questions that came up is, hey, I've got an older CEO, and they don't quite understand what's going on in the digital footprint. And I made this analogy. I said, suppose this CEO lived 20 miles outside town. He's got a big spread, big farm out there. He drives 20 minutes into the bank, the main little town. He's going to his bank job. And about halfway there's just an intersection between two county roads, and there's a gas station. And then over the years, then another store opens up. And then they go in and clear a bunch of land. They put in a big housing development, right? And over the years, this little town, this little municipality really starts to grow. At some point, that CEO says, you know what? We're going to put an ATM there, or maybe even at some point a small branch. And the reason why he or she would say that is because they physically see this economic activity growing, and they go, we need to be there. And so my point is that a lot of the older bankers,
should they still be in that position though? Well, because I come from the lending side. If I'm lending to a company and the leader of the company doesn't know what's going on in their industry, I'm less likely to want to lend to that company. Well, so why aren't we not keeping ourselves at the same standard?
The issue is that the online community, the growth of what's happening digitally is not visible to folks who are not regularly in that world, right? So if somebody is not paying attention to the growth of what's going on online in the entire digital space, then they're not seeing the economic activity grow. They're not then saying, ooh, we got to be there. So somebody comes in and says, look, we're going to upgrade our online banking. We got a whole new online banking suite. It's $250,000. And the CEO blows a gasket.
But yet they'll pay
$250,000. How are we going to afford that?
But yet they'll pay $2 million for a property.
Easily. Or they'll drop $1.5 million just on a tiny footprint branch, right, in that little community. And they'll spend $350,000 in paint and powder on just an upgrade of furniture and stuff like that in a branch. So my whole point is that when we talk about website, when we talk about online banking, we talk about mobile banking. That's
when I look at banks' websites,
and tile and Eric. I mean, there's an.
As soon as I look at banks' website, I can tell what core they're on, because what happens is as soon as they negotiate or renegotiate a core contract, they throw in a website to them. Yeah. And oh, great, we don't have to pay for this. This is free. And so 90% of the banks have this exact same website.
Exactly. And if it was a good website and it was the same as other banks, at least it would be good. But really what most banks are doing is they're looking at what's the lowest common denominator. How cheap can I get mobile banking? Can I get mobile banking for 50 cents per customer per month? And it does balance inquiry, transfers, bill pay, the basics. But if we've got to attract young millennials and Gen Zs, these are kids who have had a phone in their hands since they were 18 months old or maybe earlier. They know what a compelling customer experience is. So we've got to meet them there. We got to meet and exceed that expectation. They're not tech adopters. They're tech critics. Hey, this mobile app doesn't work the way
They're
I
also
expected.
the quickest
Boom.
to jump on. They have 5 or 6 relationships. So it's very easy. This day and age, once you get that customer, means nothing, because they'll easily close their account at any step.
That's right. So to go back to your earlier question, what I'm trying to do in terms of helping banks understand what's the real role in innovation. Number one is innovation isn't a department's job, right? So if you go to a bank and you talk to a teller, talk to a CSR, talk to somebody in bookkeeping, who's in charge of innovation here at at XYZ Bank, and they say, well, there's guys in the IT. There's some people in the IT
Yeah,
department.
the worst innovators.
They're the ones innovating, right? So that's not my job, right? And so what I talk about is enterprise-wide innovation. That at some point in time, everybody has to take on this idea of innovation, regardless of what their place or position is in the bank. And then most banks also, I think, make a mistake that when they decide to go in on innovation, they start too big. So people aren't used to innovating. Maybe it's like riding a bike. You didn't get a 10-speed, racing bike or whatever in your first time you ever had a bike. You got to kind of start.
No, you got to get a strong foundation.
That's it. So if you started with something where it says, let's just look at our internal processes. Let's examine. We have all of these process and procedures. Here's this 5-step process of how to do something. Do we need to do all of those steps? Somebody sat down and said, we got to do this and then this and this and this and this. And so the way I explain it to folks is somebody new comes in. So you got a new employee, somebody's going to show that employee how to do the things that their job requires. Here's this 5-step process, David. Here's how we do this. And the person says, well, I don't understand step 4. What? I don't get it. I don't understand what step 4 is. Now, generally speaking, there's 2 ways the trainer can handle that. They can go, hey, Mr. Peterson, this is XYZ Bank. Step 4 comes after step 3 and it's before step 5. This is just how we do things here. Get on the program. Or they could take a different tact and say, I'm glad you asked that question. Let's take a look at step 4. You know what? Step 4 has to do with a regulation. It's this thing that the government makes us do. It may not make sense, but we're required to do it. Oh, okay. Maybe step 4, if we don't do step 4, then this whole other department that's you don't even see isn't getting the information they need. So we do it so that data passes on to them and then they can do their job. Oh, okay. But maybe, just maybe, you look at it and you go, I don't know why we do step 4. Like we put in step 4 12 years ago when step 4 was important, but it's not important now. So let's get rid of it. And if we get rid of it, maybe that takes 5 minutes. Maybe that's 5 minutes to do step 4. And there's 10 people across the organization doing that. It literally adds up to 20 hours a month of time that can be reclaimed into other brainstorming innovation type activities.
So, I became CEO of Surety Bank in 2009. And my first thing, I started looking at our core and our contract, and I was amazed when I broke it down. How much per account I'm doing. Bookkeeping come out in this. Wait a second. Do we have an extra for bill pay? Do we have this? And so I had to analyze exactly per month how much it was per checking account, and I was blown away. At that time, it was like $7 per account when you had
all in.
A consumer, when they had mobile bill pay, because everything was just added on ad hoc over the years as a new innovation came out. When I looked at that, I was like, oh my goodness, we got to close every consumer account. We're losing at every single thing. Why am I selling products at a loss?
Right.
So, and then, that's where it precipitated. All right, we got to look at, doing a core conversion. And, banks are so hesitant to core conversion because they see that risk. But I tell you, that was one of the best things that I did was a core conversion. And I'm not afraid of converting as necessary if needed, because you were able to wipe away this 20-piece checklist that just added on over times. And, when you've got a 100-year institution, you're right. 90% of the employees did not know why they were doing what they were doing.
Right.
And some of the stuff we were able to eliminate because you're checking the box in 4 different areas for the same thing. We only need it once.
That's right. That's exactly right. And this whole one of the other points that I draw to my students at the graduate banking school is we have always been very core centric in our thinking as banks. You choose a core, right? And then you say, what are the ancillary products? What am I bolting on to that? This web banking, this teller system, platform automation, whatever all of those components are. But I think that the future is customer centric. What is more important? What accounting system I'm running in the back end that's calculating simple interest rates, or the online banking, mobile banking, customer facing type applications?
When I talk to banks and they send out, everything when they send out, to all their customers, say, what would you like different? What would you like best?
Yeah, surveys.
They're always, the only thing they know is what they're seeing online. So instinctively, it's always going to come back. But in general, when you look at apps, they are already so extremely efficient. The transfer between accounts, peer-to-peer, bill pay, positive pay.
Right.
It has never been more efficient possible. So what more could be innovative on an app right now. Or you're seeing like it's one of those things that I almost feel like the companies that are coming to us to say that customer centric,
right?
Really, I find 99% of them aren't offering a better carrot at all. They've got it, and they're hanging on to that because they have these surveys. Well, you pigeonholed all these customers into answering that survey for you, where they only had these choices, and that's the only thing they knew about you. So they're like, "Oh, I want better online experience." Yeah, of course, they always want a lot better, but in general, everything on that customer series, I couldn't see it works so good now.
Your point's valid. Everything about what we offer in banking is fairly proscribed, right? How one account transfer works the other, it's like money is debited here, credited there. It's pretty standard. But what's different is that especially younger folks are used to a complete customization of the entire experience. So if they're playing a game, they can go in and they have all of these ways that they can customize that game, in-app purchases and so forth. You know, it's funny. We tend to give everything away for free. I call it the 4-letter F word in banking.
Oh, banks are horrible. They race to the bottom line.
Free, but people don't ascribe value to stuff that's free. But these, they'll download an app and it's free to download the app, but immediately they're spending $2 for this Canon and $4 for this other faster, car, whatever, right? In terms of playing the game. So the customization that they can do is lacking on the banking side. We're not giving them the ability to completely customize that experience, to skin it and to say, no, when I log in, I want to go to this landing page because that's where I almost always go. All of those kinds of customization.
Yeah, I haven't seen a software company that offers anything close to that.
No, and let me tell you a killer app. And again, I tell this story over and over again. A financial institution says, we're going to allow a young person to open an account with the permission of their parents. Now, a lot of banks do that, right? So here's this 13-year-old girl. Her name is Ella. Her parents now, through the bank, open up an account for Ella. Ella then decides that for her upcoming birthday, she wants this mountain bike. And so through the bank's app, she's able to actually send information out to her grandparents and aunts and uncles, whatever, and say, hey, this is what I really want for my birthday. And if you'd like to contribute to that. So she's crowdfunding her mountain bike, right, to all of these people who might give her a gift. And it's all coordinated within the bank's online mobile app. So now grandma and grandpa, they're giving $50 and whatever else. The bank also has a customer that's a bike shop. And so they go to the bike shop. They don't tell them who Ella is, but they say, we've got a customer that wants this mountain bike. And they go, yeah, we sell that mountain bike. And I said, well, look, we're gonna basically put you guys together, but can you give a deal? Can you give Ella a discount, right? And they go, sure. If she gets to 90% of her goal, we'll sell her the bike. So now she's doing the crowdfunding. She, maybe the mountain bike's $300, right? So she gets to $270, and then a note goes to the bike company, says, hey, this person's ready. The bank automatically transfers $270 to the bike shop. The bike shop, then Ella and her parents go down to pick up the bike, pictures, social media, Ella with the bike, everything else. Emails go out to everybody with pictures of Ella and the bike. Thank you for, right? So think about what I just described. Who's happy? Is Ella happy? Thrilled. Is Ella's parents happy? Right. All of this was done securely within the confines of the banks. Right. She's not out there on some TikTok, other social media sites. Right. So is the bike shop happy? Tell me how happy any business would be if their banker was bringing them a customer. So this, when we talk about innovation, now that thing that I just described, all those elements are doable. There's not a single vendor in our space that can bring you that as a solution.
Well, I can tell you why it's too cost prohibitive. Because just in you saying that, I can already think of several payment gateways that it's coming through. So the third party is going to be taking a percentage of each one of those transactions. So you crowdfunded for that $700 bike. Lo and behold, the bank finds out 8 months later when they put together all their contracts, that cost them $25.
And here's my point. My point is simply this. If you said, I want to try and do a marketing campaign that highlights the way that we enable customers to achieve their goals and dreams, whatever the cost is for all those fees that you just mentioned is a drop in the bucket over what we would pay for marketing, for somebody to create compelling stories. We are not good storytellers, and that's a great story. It is way more valuable to us as a financial institution for the goodwill it would create of people going, oh my gosh, why aren't we right? The ability for you to get people to understand how banks help people achieve goals and dreams. Ella wanted to buy this bike. That was a dream she had, or a goal that she had. I want to save for my kids' education. I want to start a new business. These are the things we do. We call them deposit accounts and loans and all of that. We got to stop talking about that. We got to talk about what is your goal and dream and how can we help you achieve that. It changes the whole dynamic. Then the social media stories and the other things that can go viral about the story, just like the one I talked about with Ella, is worth orders of magnitude more in terms of marketing value to us than the fees that are associated with that transaction. My opinion.
Yeah.
Yeah.
I'd have to see too many case studies because in looking at it, the back end and the clunkiness of everything systems, I see where so many errors go wrong, and you've got bookkeeping you got to take in consideration. And, this is going to be, probably a few questions within one. So I've met several many bank innovation officers at conferences from banks that say, oh my goodness, we don't know what we're doing. We need to go hire an innovation officer.
Right.
And at their level, I can quickly see they didn't need to hire a big innovation officer. They can just, talk to their own staff, like you said, enterprise-wide, go into each departments. But they kind of defaulted where they've hired, say, a younger person they believe knows tech, but they have no idea that just because they understand, that'd be like hiring my 12-year-old son because he's fantastic at tech.
Right.
He still has no idea about risk or how anything plays with the bookkeeping, the CSRs, the connections in the back end, where the true risk lies during compliances and back end. And it seems to be it's that old-time CEO that doesn't know anything, and then they just hire a younger person because they believe, they understand tech.
Sure.
And that's the first thing they default to is this customer experience on the front end. They spend all of this money, and they just don't have any of it backed in. They follow this, and they did not, So where do you go from there? Is there a bank at a certain size that should be looking at the bank innovation officer? And if they are looking at a bank innovation officer, what are the characteristics that they need to get from that individual? Because I'm not seeing that they're. What I have seen is a complete, grossly wasted effort. Not that they didn't have great ideas, but they didn't have any of the practical behind it, and it just still was not energy. It wasn't throughout the whole organization.
Yeah. So your point is very valid. There are people who are bringing on or tapping somebody to be a quote chief innovation officer or chief strategy officer. There's different names, simply as a sort of a knee-jerk reaction of saying we got to do something, but without really thinking about what is the real outcome, whatever they want. So at the end of the day, you've got to decide what strategically is important for our institution based on where you are, geography, the demographics. Are you an ag bank? Are you a business-focused bank? Are you a more traditional mix of regular business customers and retail customers? Are you in a vacation or resort area? Are you next to a college, university? All of those kinds of things would factor into what I would think would be strategic in terms of how they move forward. If I'm next to a university, I'd be figuring out how to make sure I got to every incoming freshman before they actually landed on campus and set up a deal with their parents to allow them to have a debit card with restrictions that feeds back into whatever their account. There's different strategies that I might deploy. So the chief innovation officer has to be somebody that comes in that has both the forward thinking, somebody that does understand and can see new things that are coming, but be grounded in banking principles. And we can't go off as banks, second most regulated. We can't just go spin out of control and start doing stuff. Everything has to be done with the understanding of compliance and regulatory, all of that has to be there. The next thing is that they have to have, I don't know if gravitas is the right word. They have to have an ability to go to those senior folks in there and duke it out with them. And inside of FNBB, I'm called the disruptor. The CEO, it's like he'll see me come down the hill and goes, hey, here comes the disruptor, right? Kind of a joke. But I've got to be the one that will stand up and go, we don't have to do this way. There's different ways that we can look at doing this and still maintain, right, all of those rules and regs, right, and everything else. And so you've got to be willing to push the envelope within boundaries in a professional way. How do you stand up to those who are your bosses, likely the CEO, and say, no, we don't have to do it that way. And I'm a big proponent of water wears down rock. It can't just be that I'm going to be argumentative and,
no, you're not going to
throw
get
a
anywhere
fit
that
and throw
way.
my sucker in the dirt and walk away. So it's like constant, I just continually can find some other way to bring this issue back up and say, we should think about this. We should consider this. A good example of this is our bank has never been really thinking much about marijuana-related businesses and what's happening in all of the states around the country relative to full medical, sort of medical, full recreational, right, marijuana. And so, but that's something where all of the states that our bank serves, like here in Florida, all the way across to Virginia, across to Arkansas and down, that whole southeastern United States, all of those states, most of them have something, either real medical marijuana. A couple of them don't really have anything, but none of them are recreational. But it's coming. We know it's coming.
Yeah, at some
right?
point.
It might be next year. It might be whatever. So we should be proactive, right? A lot of these are ag-oriented banks. There's going to be farmers that are going to want to grow hemp or going to want to grow marijuana, and that has to be done. And so we need to be on top of that. So I started advocating last year, hey, we don't need to jump in and go crazy, but we need to start advocating and thinking about what are we doing to help our banks manage this whole problem of state laws that change and the federal laws.
I can't imagine you have any banks
whatever.
that bank cannabis.
Yeah, right. Well, it's something that was not immediately received positively within our bank, but over a period of time. Just earlier, or actually later last year, the CEO said, you know what, we do. You need to start writing some feature articles and helping people understand, simple things like what's the status of the Cole memo in terms of whether federal banks are going to be held to account for certain types of rules and regs related to marijuana. So I recently joined the board of the American Cannabis Bankers Association. So that's what I think of is you've got to be. If you're going to be an innovation officer at a bank, you got to understand, first of all, that the bank doesn't want to be innovative.
Well, we know what's going to happen. We know what's going to happen when all the banks. We've been banking the cannabis industry since 2018, and but you know what's going to happen as soon as all the banks jump in, they're going to price it to unprofitability.
Yeah. Well, you're able to price it now because of the risk. Right, you whatever your pricing is based on the perceived risk of that particular industry.
Well, you've got to look at your cost of compliance, and so you build that in.
Right.
I mean, so I know the hours.
Yeah.
We have 3 locations, but half of my staff is compliance.
Right. That's right. And again, this is the industry that we're in. We have to stop being, as an industry, we have to stop being so afraid to make a mistake that it prohibits us from actually moving forward, right, with innovation. So here's what I would do. I'd come in, I convince the CEO that they need me to be the contrarian, the person who's going to advocate for positions that are non-traditional, but who will then obey and do whatever the actual CEO and the board decides, right? So I'm going to give you my opinion. I think we should do this. I'm going to strongly advocate for that. And then at the end of the day, if that doesn't happen, I salute smartly and I, move forward. And I'm an officer of the bank, so I'm not going to be, doing bad stuff right behind the scenes. But next, this idea of how do you get everyone else in the organization thinking about innovation, even in very, very small ways, and in every single thing that they do, to be open to and looking for some even very small thing that can be innovative. And I believe that once you get people thinking about small innovations, and they get some successes with that, maybe get a few kudos for that, then they go a little bit bigger and a little bit bigger. And eventually they take on much bigger innovation projects. And the third thing is that FNBB did something I think very important. Everybody at FNBB now has innovation as a part of their annual review, right? So within our core values, the things that we say that we believe as FNBB, innovation is one of those. So when it comes to review time, everybody is saying, their manager is saying, okay, tell me how did you do on all these core values? So if you tell somebody that they're being held to account for their raise or bonus or promotion in the bank, and now innovation's a part of that, it's really surprising how much they sort of take on this idea. Well, you know what? Maybe I will spend some time thinking about innovation. Maybe I'll join a team of some other other folks who are thinking, about doing this. And we have a great example of this. Just Monday, so where were we? Wednesday, 2 days ago, we released a white paper. It went out to all of the banks. And it is something that I started over a year ago with a group of under 35 bankers at FNBB, thinking about what is it that we could do to help our banks understand how to attract and keep young millennials or Gen Z bankers. Because I think if you can do that successfully, then you have a long runway, right, of older people dying off, new people coming in. You're not declining from a customer account.
Assuming they continue to nurture that relationship
That's right.
too, and
That's
they're
right.
just
right. And if I lose this baby boomer and they've got $100,000 in deposits, it's going to take 10, 12, 14, right? I can't do one for one, right? Because these guys don't have that, right? So they're going to eventually get there. They'll accumulate some net worth. So I took this group of younger bankers and over the past year worked on and came up with a white paper that just published on Monday. So somebody here at the bank got that in their inbox, right? So when you look at that, it basically says banks have to focus on 3 areas: marketing, advocacy, and technology. These are the 3 areas where if you do some specific things, if we start thinking about the gamification of banking, if all these young people like to play games on their phone, why can't we make banking a game? Why can't instead of Angry Birds, why can't I have, angry banking, right? Why can't I pick up $100 and put it in a slingshot and fire it into my savings account? Why not? So these are the kinds of things where if we can refocus the world that these younger folks live in and their attitudes towards what that customer experience looks like, then we can get closer to meeting that with our digital.
What's funny, a lot of it has to do with culture too, because over in the Mideast and Dubai, their banking apps are all inclusive, where it's discounts on branding, where they spend hours on it. That's important to them in the area, that they're getting discounts to, clothing, movies, that kind of stuff, music.
Yeah.
They have that all embedded in their banking apps over there.
If I was doing mobile banking today, if I was a CEO of a company and we're building mobile banking, I would literally build an app that basically says at the beginning of the month, everyone gets a notice on their mobile phone that says, "Hey, it's March 1st. Your charge for banking is $12.95. That's what it's going to cost this month. And do you want to know what we do for that $12? Click the little I. Look at all this stuff that we do for you for $12.95. I mean, do we really provide less value to you than Netflix? I don't think so. I think it's worth $12.95.
I know.
But wait. Here's the trick. Game on. So everything that you do over the month can reduce that $12.95 down to zero. Right? So think about it. What banks do is they say, it's free. Your checking account's free. But then if your balance goes below this, no, you got to pay. Right? So we give them all these things they can't do. Make it a game. It's $12.95. It's worth $12.95. But if you have, keep $1,000 in your account, we'll give you $2.50. If you do Visa signature debits, we'll give you 50 cents for each one of those. You have direct deposit coming in, we'll give you $1.50. Right? All you have to do is reward them for good behavior. Stop punishing them for bad behavior, and all of a sudden it becomes a game. Every time they open their mobile phone, it says, "Hey, your service charge now is down to $3.95. Here's a couple of things you could do this month." So they get an overdraft, and all of a sudden they've got a $25, $30 charge on there. It's like, you know what? Sorry, but you can even erase that. Go if one of your friends opens an account with us this month, we'll give you a $30 credit. All we have to do is make it a game, and they'll play.
Yeah. I want to move on to another topic, banking as a service.
Yeah.
So, do you read the consent orders that are coming out against banks that have provided banking service and how they've done it? So what are your feelings? That was the innovation.
Right.
So now we have, a couple years of the banks that have jumped away to banking as a service, and Basque, a lot of things that are doing it on the year end. So, talk to me a little bit of your thoughts of what's going on in that industry.
So, for those of you that may not be steeped into banking as a service, whatever, what happened is there were organizations that wanted to be able to put a front end, hey, we want to go out there and attract these folks. And there needs to be a bank account, an actual bank account right behind there. And so entity A would basically wind up having a single bank account, and there would be a shadow ledger for potentially thousands of people who actually had deposited money with this banking as a service, right? And it was all kind of in this one account, and then you knew how much each, Ryan had this and David had that and so forth. I think the bigger, I think again, the devil's in the details, right? So some banks were very high profile going after those companies, saying we're going to basically be the banker inside. Green Dot Bank was a big one, and Bancorp Bank, Silicon Valley Bank was doing it. But Atlantic Capital and Atlanta, there was a bunch. Main Street Bank, there was a lot of banks that were saying we're gonna kind of bank that fintech world. I think at the end of the day, not all of those banking as a service organizations kind of played fast and loose, but some of them were doing things like telling their customers that they had FDIC insurance when they didn't. Yeah. Right? I mean, and
but
again,
if you keep the ledgers accurate, you get past your FDIC insurance through the for benefit of account, FBO.
There was a lot. Let's just say that's one little small
example. Yeah, that was in the crypto world. They were saying FDIC insured. Right.
Yeah, and there's a banker that I know of, I'm very familiar with in Nashville, Tennessee, and their bank was one of these. And the whole thing fell apart. And at the end of the day, I don't know. Did the regulators swing the pendulum too hard? Some of the people played fast and loose.
So
with it,
here,
but the regulators aren't somebody who says, we're going to be innovative.
I can tell you. I can tell you my side. So, I launched a digital bank several years ago with the court very quickly because, a digital bank really, once you already have online banking, it's simple. It's changing the color code of the app. If you've already got the app, a core can easily do that.
Yeah.
You can bifurcate it by buying a separate routing number. It only costs you I think at the time $650 for a sub routing number, so you can keep that ledgers.
It's like a pop-up bank where you just say we're going to have a different persona out there, different name, but at the end of the day, it all rolls up under the holding company.
Correct. Yeah, or the main bank, depending on you own it. Right. You can own it, not own it. So I've got a compliance background. I want everything compliance. I want to control everything. But what I noticed, I got a random audit. Of course, they saw a press release. Next thing I know, there was nothing but $6,000 on deposit, and I get like all these examiners in charge. But what I learned during that time, what they were saying, well, if you don't own it, we don't audit it. And I said, I don't care. I need to know everything. And there was nothing wrong, but a couple things I learned real quick during that time. Nobody truly knows reconciliations like banks do. Even on those small accounts. Mm-hmm. The company that was gathering a relationship, they did not understand reconciliations. They didn't know that their interchange charges should not come out of for benefit of account. You had to explain that to them.
Right.
So immediately, it was the partnership. No, we shut it down very quickly because I didn't, the partner, they didn't get it.
Right.
And they were looking at one side of the ledger. They truly did not know what a true reconciliation was. They didn't. And many people went through there, and I was like, are you kidding me? The basis. We have to be to a penny every day. We're going to oversee your butt. We want to see that file daily, that last night you reconciled a penny and any outstanding items, you know exactly what they were.
Right.
And they couldn't do it, even with just a few accounts. So great. But then told me, so now the regulators are coming back. Yes, it still is the liability of the bank regardless. So you have to verify all that, they're advertising. You have to verify their reconciliations. You have to go through there.
Are they doing the right KYC, everything?
Correct.
Right.
And then that's the other things. Fintechs don't understand KYC the way banks do.
No.
They do it as a checklist. They don't understand that is the beginning, and you got to look at ongoing monitor. You got to get a basis of their transactions and what is out. So they're not running
BSA, OFAC.
They're not running everything. They'll do that front checklist things, but then they don't do the ongoing running, and that's your responsibility on top of that. So now when I'm reading these consent orders, that was the exact same thing I told the regulators now going on 6 years ago. I said, are you kidding me? No. If I'm going to do this, we're going to be in charge of all the compliance. I'm not going to rely on somebody else. So I swear banks, some of them made some really bad decisions. And not only do they outsource their marketing, they outsource the compliance and that banking as a service.
That's right.
And at the end of the day, if that model was highly successful, now what happened? They're in a worse position because they're dependent on all of their deposits for one relationship.
That's right.
That can move them. So it was just like, they didn't think any of it through from the basis. And the banks, how in the world could you be out 14 million in reconciliations? And the other thing that I would really caution is anytime a bank wants to get involved in that, they're not validating what the fintechs are saying they're doing.
Yeah,
They're not. They're not getting a third party to say, go in there and validate exactly the controls of that app that cannot be changed and who in their organization can change them and what are their roles.
Right.
They're not getting into that granular that they are on themselves.
Yeah. Think about this. What is it? 5-6 years ago, the OCC decided they were going to allow a charter, like a fintech charter, right? And so there was a couple of fintechs
because you have like Discover that had limited charters,
but how many actually went forward and got that charter? I think I know there's one, but what people realized is holy cow, what a pain in the ass it is to be a banker, to actually be a bank, and all of the rules and regs. It's far easier for them to say, we're going to pretend like we're a bank and then have the bank be on the back end, but they're not focused in the same way that you are here at Surety Bank to make sure that every I is dotted, every T is crossed, everything is reconciled.
We're compliance.
Right, that you know that all of that's there. You're going to be innovative, you're going to be forward thinking within the framework that you're allowed to work.
Well, we're stewards of other people's money, so I mean, you have to reconcile. Right. If you can't reconcile, you should not be a bank.
That's right. And that's the important point, is that the banking as a service, they don't think of themselves as banks. The people who are running that
act like a duck, talk like a duck.
Right.
You are.
They're out there just saying, hey, we're going to go out there and offer this bright, shiny object to some particular niche because we think we can. And you know what their advertising says is, oh, you don't want to bank with a traditional bank. They're old, they're antiquated. Come bank with us. And then, of course, there's an actual old antiquated bank behind the scenes.
No, well, I mean, we're all bound by, the antiquation of the Federal Reserve. So no matter how great the front is, we're still all processing through the same items.
That's it. All I know is that this is back to this thing of if in fact it was so great to actually have an FRB ABA number, a bank charter where you can have that, there would be a lot more activity in that area. But it is not easy to get a bank charter, and it's something that's
we're down even less than half of new applications than we were a year ago, which was I think only like 14, or 2 years ago.
Right. Exactly so. And so this idea of we have a franchise, a financial institution has a franchise, something that's, I think, extremely valuable. And if for nothing else, if you just looked at it from the standpoint of your ability to initiate payments, your ability to interact with ACH, checks, wires, cards, now faster payments, FedNow, RTP, whatever. That's the franchise. That's the thing that a bank gets to do that really no one else gets to do. Now, there's other P2P companies, there's other stuff going on, but eventually it all comes back to a bank at some point doing some type of transaction bank to bank to settle up all of those transactions. That's what we get to do that nobody else.
Yeah.
Loans, other people can make loans. Other people can take deposits.
Well, I mean, majority of home loans now are through, are not even originated through banks anymore.
Right. So this idea of banks' attitude towards payments, when I think about most community banks, like obviously FNBB, we have about 680 some odd banks across the Southeast. A lot of those are small community banks. They're not very proactive into going to their business community and getting them set up on ACH origination or, more advanced payment types. A lot of those banks aren't even really considering yet something like FedNow, which could be the future of how instant payments is going to go. So they're looking at it more of the expense and the hassle. I don't really have anybody asking for it. And so they're reticent to be more aggressive with payments. And my point is payments is what you get to do that no one else does. When a company is doing their payments with you, when you're doing their ACH and payroll, when you're helping them initiate all of their fees, when they're maybe using FedNow and doing requests for pays and getting paid instantly, so forth. You have integrated yourself tightly in with their cash flow, and you become very strategic. You're not just somebody who's holding their account.
I agree with that because, I mean, when banks were actually invented, back in Europe and the banking system here, it was for payments. It's for transactions. So people didn't have to move money. It didn't start from lending. Right. It was being the conduit and making the transactions between.
That's right. That's exactly right. And I do think that, from a lending example standpoint, I go back to this idea of telling stories. It's not been so long ago that we had this thing that we called COVID, right? This whole COVID pandemic and everything shutting down, right? So what happened is somebody came up with the idea, we got to provide these businesses with a way to bridge over until things can get back to normal. And so we came up with the PPP loans, right? Did you guys do?
Oh, absolutely. Loans? I mean, I was up all night inputting them the first time.
Exactly
Yeah.
so. And I would suspect that if I was a Surety Bank customer and I was running a small business and it was shut down because of COVID, and I came in here and said, look, I need help on the PPP loans. You guys were on top of it with me as a customer of yours. I was first in line for anybody else who showed up in the bank and said, hey, we want a PPP loan. You're like, well, we're taking care of Surety Bank customers.
100%. That's
right?
what we did. Yeah.
And I know there's a lot of young, I personally know some young millennial entrepreneurs, people that started companies who qualified for PPP loans, but were not banking anywhere. They didn't have a actual solid relationship with the bank. They didn't have a banker, right? Somebody could pick up the phone and say, hey, I need help. And they were going to community banks. They were going to Bank of America. They were going anywhere they could saying, I need a PPP loan. And everybody was saying, okay, just get in the back of that really long line.
There's
right?
a queue.
We might get to you, right? So here's a great story. Here's a great story. When you have a relationship with a bank and all of a sudden the crap hits the fan and you need help, the banker's there to help you. And look at this example of PPP. Now, maybe it's not another pandemic. Maybe it's something completely different, but there's a reason why you need to have a relationship with a financial institution and a banker. Somebody that you can literally call on and say, hey, I need to advance my business. I need to open up another facility. I need to borrow money for inventory, whatever it is. Or, hey, my business is shut down because of the pandemic and I need to get a PPP loan. But we're not really telling that story, right? We're not using how we helped people with PPP loans as a part of our social media campaigns and so forth. So that's where I'm trying to get banks when I write feature articles and stuff for FNBB. If you can tell a compelling story versus just having a website with a bunch of bullet points of brochureware and, hey, we'll make you a loan, and that's all well and fine. But how can I tell a story of how I helped a business stay in business through a rough time?
Well,
that seems more.
And what was it? Community banks that are, the percentage of dollar deposit the community banks hold to how many PPP loans we did. I think we did like 70 to 80%.
That's right.
It was so overwhelming
That's right.
that we did all that. And
that's exactly
and back to I think there isn't, what people don't realize, or bankers do, there's no separate charter for a community bank. We all have the same charter.
That's right.
And people throw out community loosely. They use it sometimes to their benefit, and sometimes it can be a detriment.
Right.
Consumers sometimes in your community, they think you don't have the technology. We have that. Could have been the same. That was true 20 years ago, but not now.
That's right.
And a part of, I tell you, when Surety Bank, we've been around since 1926, so we've been through every single recession. One thing that I caution people, like, you want to go to a major bank and then a recession hits and you can't afford that 6%, but you can afford 5%. Good luck with that big bank doing anything. They will foreclose on you as quickly as possible. Right. They will not modify that. 9 times out of 10, there's always going to be exceptions, and there's no one there to talk to you about that mortgage. That's right. So, you pay for what you get too. Right. So,
one little, I'll take one little divergent from what you talked about. So again, go back to 20 years ago, the community bank's technology didn't stack up to the
not at all.
Guys, right? And so then you fast forward to say 5 years ago, or even 8 years ago, and the community bank's technology really advanced. And yet, in some ways, it actually was easier to work with a community bank because the larger banks had gone through a lot of big mergers. They were having some trouble trying to figure out how they were going to merge together these huge technology stacks. But over the last 8 years, Bank of America, Citi, Wells, Chase, like all those guys, they have spent billions of dollars on their technology stack. So when you talk about the kind of customization that I talked about earlier, I mean, those big banks have really, really good digital platforms. And in many cases, it's vastly superior than most, quote, community banks' digital platforms. So it's kind of swung back. So
really,
again.
You should be going to the major cores of telling them they need to do a better job of innovation, and the bankers need to demand it.
Yeah. And I have a little bit of different attitude towards that as well. So when you think about a core provider, they're running the main accounting system, right? And then you have all these ancillary products. And most cores will have their own suite of ancillary products. And then there's other third parties that also provide some of those ancillary products, which may or may not be able to integrate with the core depending on how open banking friendly, right, the core is. So here's the way I think about it. If my core, if the core is the primary thing that this vendor is writing, then the bulk of their R&D resources are going into the core, and then they're also spending money on the ancillary products. So what I generally find is most cores have good online mobile banking, but third-party vendors have much better online and mobile banking. Like a vendor that only does online or mobile banking probably is pouring all of their resources into that because that's all they do. And therefore, if you look at all of the customization and the customer experience and the feature function of that, it's superior to that same mobile or web banking from the core. So I look at it two ways. Number one is, if in fact I'm right, and that whatever is customer facing is more important, right? If I'm on core X and then I move over to core Y and you do the conversion you talked about earlier, how does my customer know about it? Well, maybe the statement looks a little different. They even look at the statement, right? But they're not really they don't have any knowledge of what I'm running in the back office to process deposits and loans and GL. But if I change my online banking, if I come out with a new mobile banking service, if I do anything that's customer facing, that's immediately visible to them, right? So think about it. To use your earlier example, there's a very good strategic reason why you need to move from core A to core B. For whatever reason, core A is not going to be the future for you. You think core B is, but you're using core A's mobile banking, online banking, bill pay, on and on and on, all of these customer facing things. Now, if you move over to vendor B, all of those in-house online banking, digital banking platforms don't work for core B. You got to get core B's online banking. And then all of a sudden you look at, well, how many customers are we talking about? Oh, it's 10,000, it's 25,000. There's 50,000. We got 100,000 people, right, that are on online banking. And so this is what happens is most banks get to the point where they look at what's the effort to get all of that customer facing stuff moved over. And at the end of the day, they make the decision to stay with core A simply to avoid having to move all of those customer facing things, right? So if that's an issue, and again, I'm not anti-core. I've worked for cores in the past.
No, I mean, we need them.
I started my career at Kirchman Corporation down the road in Altamont Springs, right, as a programmer. So if I have a third-party online banking, mobile banking app, and it interfaces with core A, and then I decide that I need to move with core B, then I make my online banking, mobile banking interface with core B. None of my customers see anything different, and I'm able to take advantages of what I think are strategic things that I got to do with the core, unrelated
and
to
the industry is getting more favorable to that with
open banking, APIs. That's right. That's right.
And then what I find is whoever having the online banking, if you're looking to segment in other third parties too into that, some of them, is it going to be within the frame? And it needs to be within that app, so it's not separate, not to where it opens up a window. And there's a lot of content.
That's right. And faster payments is gonna be another element to that. So financial institution decides that they're going to offer FedNow. Okay, does that mean that my online or mobile banking application is now adding a UI that allows me to say who I want to send money to, how much, and from what account? And just to your exact point, is that something that opens up natively inside of that app? Or is it a link, and when I click the link, now it goes over and it spawns out over, to something else, and it looks a little different, may have the bank's logo in it, but it's actually different. There's nothing wrong with that inherently. Those are all choices and decisions that individual banks make about what's important in terms of how that mobile app looks to the end user who is almost exclusively using it as their touch point to the bank. They're not coming to the branch. Right, they almost do everything on online or mobile. Yeah. So how integrated, right, do I make that? There are banks that are not even $1 billion in assets who actually create their own mobile and web presence. They control all of that so they can use their development dollars to make that look and do whatever they want, regardless of what partners.
Well, I mean, they can make changes a lot quicker too, and that is. I believe small banks can be profitable. Anybody says they have to be $1 billion to have a good return. No, they're the problem, not the bank. Right. But it would like to get to the scale to where you have some of your in-house in regards into controlling some of that aspect. Right. Because, realistically, if you go to your core third-party vendor and you say, hey, I have this idea, I mean, they have to allocate the resources to that, so it is costly. They're gonna have to pull employees off other projects and that kind of stuff. So there is, and I get it.
Yeah. And again, there's a whole new breed of core systems that are coming out that are basically saying,
hey, they're getting bad news left.
We're completely and totally up. You can, and so FNBB, we're no different than any other bank. We have a core. Now we have very fewer needs than a commercial bank, right? We have no business or consumer accounts. So we only have your account is one of 750 DDA accounts total, right? So, but we have to have a core. We were on a very, very old core with one of the main three vendors. And so we're doing an evaluation, no different than anyone else. And so we said, well, let's take a look at one of these new cores that are basically offering a completely cloud-based core, right? And so I go, and I'm a tech guy. I started my career as a programmer. I worked at Kirchman, which is now Metavante, which is FIS. Yeah. And I also worked at Broadway and Seymour, which is Jack Henry, right? So I've got a lot of experience, whatever core. So I put together my evaluation. I look at this. And so we're sitting down. I'm not going to mention the vendor's name, but it's one of these cloud-based cores. And you look at it, and it was made for the banking as a service world, right? And so what they're trying to do is they're saying the banking as a service isn't going so well for us, so we're going to turn around and actually sell this as a primary core to regular community banks, commercial banks. And so what you find out is that you can program this thing to do almost anything, but out of the box, it doesn't do anything.
Yes.
Literally, I said, just go in and show me opening a simple interest loan. Well, first we have to define what you mean by simple interest. What are you talking about?
Yeah,
so, you got.
And I believe I know who you're talking about. Where I looked, I was like, well, what you're saying is amazing, but I have to hire 7 coders or to do this. It was like, no.
And again, it's like you buy a system,
it was like buying Salesforce, blank Salesforce, and then having to do everything on top of that. Right. And we're like, oh.
Right. It's like most banks need to get something out of the box that does all of the accounting stuff they do, and there's function keys, and it just automatically does things. And these newer systems, which, again, if you were going to create something very, very unique, like a banking as a service, how great is it?
Well, dude, as simple as, we've had issues. We're real time. Of course, when we say, we're real time. Okay, that's great. We still have to have an end of day snapshot,
right? So
we can reconcile,
right?
That has to have that form. I can't just go in and pull it every time I want to pull that. It was simple little things like that. That it was real time. You can get it anytime you want.
Right.
No, I need it daily.
Right. Business comes to the teller line, and they have 100 checks to deposit. Now, why aren't they using remote deposit capture? But walk with me through the story, right? If you're running real time, you can't just take one of your tellers today. Somebody comes in with 100 checks or the deposit slip. They basically would just give that customer a receipt for that, or they would literally run it through the machine right there. But in a real time environment, each one of those items gets processed as like literally nobody's going to stand there and people think of batch. We talk about batch processing as being somehow antiquated or bad. It's like there are really good reasons, right, why something like ACH, which is a batch processing, is really, really good for things like payroll and very inexpensive. If we said, oh no, we're going to run all payroll on FedNow. Really? Because everybody I know exactly how much somebody needs to be paid, but I got to run it as a real-time transaction at a significantly, right? So we tend to think of stuff that's batch or as being inherently antiquated or bad, and that's not necessarily true. There are certain activities to which a process or procedure is perfectly suited for it, and we shouldn't be trying to force things that aren't suited for it into that, or take and say, oh, well, that's old. Let's go over here and do it all real time, as if that real time is the panacea for all problems.
I know we're probably running close on time, but 2 other things that are consumers that I have a strong opinion to. I want to see what you got. One is where they're offering direct payroll,
instant payroll, like
2 days in advance.
The gig economy.
2 days in advance. Consumers at their bank account
get it early.
2 days in advance. So what you think of that? And then to the idea of NSF fees being junk fees.
Yeah. So I do have opinions on both of those. First of all, I think that the idea of somebody that says, hey, we'll give you your payroll a couple days in advance, I don't necessarily think that that's problematic. I'm not even 100% sure of what the rules and regs might be about that, but somebody basically says, we're going to if you get paid on the 15th, we're going to make this credit available to you on the 13th. So you get your money, or even part of the money. Maybe in some cases it's not.
Typically, most of them are giving them all because it's recurring.
Right. So what it really comes down to is what you and I would know about the accounting. If ABC Corporation says, here's all of the people that are getting paid, it's $1 million payroll across all these employees, and they send that information to you on the 13th. Right. And then you're sending out all the credits we're going to post on the 15th, and you've got an offsetting debit, right, to ABC Corp. Did you debit them on the 13th, or are you debiting them on the 15th?
The 15th. So typically it's, in essence, a loan.
A loan, exactly. And so therefore, if I'm giving my customer a loan as a service, do I have issues just like is happening with the buy now, pay later stuff, where all of a sudden I'm not following Reg Z, blah, blah, blah. Is it actually a loan? All I really have is a situation where if the funding debit to them doesn't happen on the 15th, and I've distributed all these funds on the 13th, what happens if ABC doesn't pay?
It can change. They have to alternate it on the 15th.
Right. That's right. So that's simply a decision where somebody's saying that I'm willing to take 2 days worth of $1 million of both potential overnight investment, as well as the risk that ABC company won't fund on the 15th, and saying, I'm willing, to allow this to come. So I think that's a reasonable, right? If I have a good relationship with ABC company and I have other means to secure, right, the originations that they make, every time a customer originates a credit file with me, it is an unsecured, right? Because I'm sending those out. It's going out to everybody on the 15th, but they have an obligation to fund that, which I'm going to debit them on the 15th. And if I don't have a solid relationship with them, some banks might pre-fund. They say, we're going to debit you on the 13th so that we have these funds, and then all the debits go out and they all get paid on the 15th. So I think that's a decision that an individual financial institution can make relative to how comfortable they feel taking on the risk of an advancement.
Yeah, there's obviously cost, opportunity. Like, you don't have the $1 million yet, so if you had to borrow it from overnight funds, it's going to cost you. Or you didn't invest; that's money you took that was already invested in overnight funds, that lost interest over those days. And then if there are changes to ACH file, because they can change up to that day, maybe the payroll. But I think overall, as society, it is an absolute horrible idea, and it's conditioning people to be horrible stewards of their money.
Right.
And,
that's right.
Where the consumer thinks it's a great idea 2 days early. What is that 2 days really going to do for your money? If you can't, how are you ever going to get ahead? How are you going to move forward?
Right.
It's just conditioned like it's a bad idea.
2 days before becomes payday, and now I want it 2 days before that. And before, right? I'll just readjust to that.
You're turning that. I think society overall, it is completely horrible.
But the marketing campaigns like Capital One was a big one, making campaigns about offering that. I could see where, again, maybe even for some of those younger folks, right, who are like,
but I think overall, as they look, who they're going to attract that switches and says, I'm going to bank with you because you give me 2 days earlier. There's a cost to that. They have to make up that cost. So where are they going to make up that cost?
Yeah.
They're going to make up that cost in customer service. And that's why if it's not found out in the FAQ or their new AI chatbot, you're not going to get anything. Go dispute something and see how long it takes for anybody to get on the phone. They had to build in that cost somewhere.
I'm with you there. The other thing you asked about was the NSF, the attack. I call it the attack on overdrafts. Right?
Correct.
Couple things. Number one is I'm not steeped in the numbers about what the actual cost to a financial institution is.
I can tell you our costs. Our cost is minimal. We still have an individual look at that, and there's a decision made.
That's right.
So you still have a human cost coming into it, but minimal.
Right.
And we're getting charged from the Fed, minimal. So, I mean, it's dollars.
So
it's not.
Here's what I think happened. Back in the day when overdrafts, the amounts kind of really ratcheted up to get to $25, $30, some $40. There were really costs associated with that. Not the least of which is that most of the time they were paying those items, right? So I'm paying the item and then charging an overdraft.
Or they were returning the they're paying the larger dollar item first, and so they would have multiple NSFs and working.
Right.
That is bad.
Yeah, take all of that away.
Yeah.
What I think could have happened is as banks' technology improved, and they said, you know what, it's not really as expensive for us. If they had brought, instead of $30, $40, if that had come down and overdrafts were $15 or $12, right? If they had cycled those down to be more appropriate to the real cost, right, of doing it. I think the problem is it's so, I remember being a part of a community bank. I was on their board of directors, years ago, and the amount of non-interest fee income generated by overdrafts was significant, right? For smaller banks, it's a really kind of a big piece of non-interest fee income. So they were kind of hesitant about.
It's actually less for smaller banks. It's minuscule. I mean, we have a couple grand a month. We would rather not have any fees associated with that than there be overdrafts.
Okay, this bank I'm talking about was a Georgia-based bank, and it wasn't the highest one or whatever, but it was significant. It was a significant amount. So we, if you start thinking about, well, we could do an overdraft protection program, everything else, and it's $5. What are you talking about? $5? It was $40, right? So overdraft fees are not junk fees. NSF fees are not junk fees. Biden's comments about it notwithstanding. And the CFPB and the FTC and those are really trying to go hard after that to kind of say this is something completely and totally usury. This is outrageous, right, at what these banks are doing. And what I've never seen anybody, not anybody from the government, not anybody from any of these agencies say is what is the impact to a customer who has an item, comes in, and it's rejected? What happens when their mortgage payment, when their utility payment, when whatever it is that we would pay and charge the overdraft fee is just simply returned?
Oh, it's huge.
Right.
And they don't mind paying the overdraft. And I think of that as the exact same way as paying, like, I have an 18-year-old daughter. Of course, she's had an account at the bank since we got her debit card at 12, 13.
Yeah.
Even from the get-go. If you don't pay attention, you got an app, you can see the account. And from the get-go, when she purchased something on the debit card, did it show up? And when she drove, okay, you got gas. What did it say on there? Showed $1.
Right.
Did you pump $1? No, it's going to set it tomorrow. You better know that.
Right.
Your daddy's the CEO. I will not waive any NSF fee from you.
If you show up on the NFS,
you're paying that.
Right.
You're paying that. But she hasn't got an NSF.
Yeah. Right. Because you helped her to understand that it's her responsibility to watch.
But I look at the fees as keeping them, okay, that yes, $40 is outrageous. It doesn't do that. It was a couple of dollars. But, and again, you've got to teach people, no, there is a penalty for not managing your account.
Right.
And I can tell you, the customers that habitually overdraft, they're the greatest risk as far as leaving you in the lurch for, they're the ones that are going to run up $100 on gas. It should $1. Yeah. Do it with the spouse, $200, and next thing you know, you're $200 in the hole. Right. And thankfully, you had some NFS the past year that covered that.
That's right. And even the more recent thing on the Max credit card late fees, the $8 thing that they're doing if you have $1 million cards.
Yeah, so you're encouraging them to just leave money on the credit card and ongoing.
And I think that some of the opinions that I've seen about this says that there will probably be more late. The lower they make the fee, the more likely that people are going to go late.
Absolutely.
Right. And incur all of these other interest charges, whatever, in addition to the late fee. So
everything the CFPB has done is put consumers at the greatest risk and the greatest dependency on everyone else. Their credit card volume is at the highest it's ever going to be. And fees, they choose.
Yeah. I really don't want to be a CFPB basher, right? I mean, but it does appear
I will do that for you.
It does appear that their modus operandi is more about punishing banks and less about coming up with ways that consumers can
I like to think they have great intentions in the beginning, but then don't understand, human nature after the fact. They're right. Yes, they're going to leave a longer balance if it's only $5. A low rate environment is not good. Too, we had so many years where it was easy to get a 3% mortgage, a 30-year fix. So what was next? It was going to go to a 40-year. It's going to go to a 50-year.
Right.
And then when you have low mortgages, the price of housing far exceeds your median income. So, housing median income started skyrocketing in the 70s. Why? Because a 30-year mortgage came out in the 70s.
That's right.
And then you got interest only, one of this. So all it did, and so now we're in the focus that the percentage of household income to the average household is way out of sight. So it's only going to get worse when we have that lower rate environment and everything too. So they're a happy medium. I'm not saying the rates right now need to be there, but
At the end of the day, I'm gonna.
We need to incentivize good behavior,
right.
not bad.
That's right, exactly right. And I'm gonna assume that they have good intentions or had to try to do the right thing, but the unintended consequences don't appear to be a consideration.
And it's one step removed, which is amazing. It's not like, well, 3 steps from now, it'll be the second generation that has the fault. It happens immediately, yet they still think it's a good idea. And I have no idea. But, we're getting close to time. Is there anything you would like to leave the, episode with or talk directly to banks? Anything left on innovation?
Yeah. Here's what I would say is at the end of the day, we have to think about who our future customers are going to be. So all I really think about on day in and day out is my 14-year-old grandson, right? It's a cool kid. In 8 years, he'll be 22. Let's just say he goes through a traditional model of graduating high school and going on to college, and he's going to start a career job. What is it that my bank, if I was the CEO of a bank, what would I start doing right now if I wanted to make sure that by the time he was 22, that he not only was a long-term customer for me, but that understood that he could start a business, he could buy a car, he could buy a house, he could make his journey through life and be able to allow us to assist him right with those goals and dreams. And if I start with that and I think, well, I don't have to have everything done right for 8 years from now, but I got to get started. I got to decide what's the most important thing, and then the next to crawl, walk, run myself right to get to the point where I'm relevant. Right, for that particular individual. And I think about all this online digital presence. I think about the retail space. So in order to get up to this beautiful podcasting room you had here, we had to walk through your lobby. Is there any compelling reason why a 14-year-old or 16-year-old, 18-year-old needs to come into that branch? Probably not. Open their account and then maybe they don't come in again. Yeah. So if I have a lot of unused space in those lobbies, what can I do with them differently that would actually make it a place where they would actually come in? One of the ideas that I give to my students at the Graduate Banking School is we're here in this podcast area. And it's really only about, what is this, about a 10 by 10 space that we got here?
And it's not very costly. It's very easily to do.
But this, what we're doing right here could be in an enclosed space actually in your retail lobby.
Of course.
Right? And if that was there, some customer comes in and goes, what is that? What is that over there? It's like, yeah, we got a podcasting booth. If you would like to record, podcast, whatever, you can sign up and register, and your customers could now come in and start recording a podcast. So younger kids like, hey, you want to start you want to put something out on YouTube, whatever. Now, here's the amazing thing, Ryan. As soon as I talk about that, what's the first thing the banker? Wait a minute. Wait, they're going to record their podcast. What are they going to do? What are they going to say? What kind of liability have? What? All they can do is think about all the terrible, awful things that would happen, right? If they did that.
You don't air it if it's bad.
Right. So again, if this whole thing is not about making mistakes, it's like if we were talking baseball, the bankers would simply tell all their employees, just don't ever strike out. I don't care what you do at the plate, but you can't strike out. Well, if you go to the plate as a baseball player with the goal of not striking out, how many home runs are you going to hit?
Yeah.
Very few, right? Because the home run, people lead the league in home runs, also lead the league in strikeouts.
Correct.
So if we want innovation, if we want stuff to happen, we're going to have to be willing to allow a few strikeouts, learn from that, iterate, make improvements, whatever, but doing stuff like putting something actually in the lobby that's visible to everybody. Maybe you have a MakerBot 3D printer and kids can come in and they can bring a project on where can somebody go here in Central Florida and go print, a project, whatever, on a 3D printer, right? So anything that might be of interest that brings them in, you're exposing them to the brand, you're getting them to understand. Maybe you start having some programs tailored towards financial education, understanding things like you were talking about for your daughter about managing their account. It drives me crazy. The young people I see, they look at their balance and that's available to spend. And just like you said, it's like, no, there's debits that you've done that hasn't come out of that yet, and you're not thinking about those, and boom, all of a sudden you overdraw your account. So there's a lot of things like that we can do, but I think it starts in the visible areas of the bank, the public areas of the bank where people can see it and go, what is that? What is that over there? Yeah, and then if that's something that draws people in, regardless of their age or demographic, you're exposing them to your brand, and you just kind of continue that so that you sort of become, oh, I can do this here. I can do that here. I can actually create an account here and be involved in P2P and other stuff. I think that's the best long-term way to crawl, walk, run to that 8-year time frame.
That's wonderful.
Awesome.
Great.
This has been
David,
great.
Thanks for
awesome.
Thanks for being here.
Yeah,
Pleasure. Thank you.
Appreciate it.